Hi, this is Ian Coleman from Signal Centre. Today I want to talk about euro dollar, but I briefly want to talk about the dollar index. Now, we've got the FOMC or the Fed interest rate decision and the FOMC press conference released tonight. Widely expected to be kept unchanged at 2.5%. But what we have had this week is we've had basically a bit of a war of words between Draghi and Trump. So basically, Draghi highlighted that there was scope for some more fiscal stimulus and potential rate cuts. Trump didn't take kindly to that. He's now saying that Europe and China have been basically orchestrating unfavourable financial conditions for their jurisdictions for some time, and it was unfair on the US. So we're having this not battle. It's more of tweets from Trump than retaliation from Draghi, but we're getting that uncertainty, if you like, of what is going to win over, lower euro or lower dollar. So let's look at the technical picture, and the technical picture still gives a dollar bearish bias. So if we go to the weekly chart, we're holding within a wedge formation. A break of support is needed, which is around about 96.68 to take us down towards here, which is 94 the figure and the measured move target. Levels close to the 61.8% fib continue to find some selling interest. Now, if we go to this chart, this is still the daily chart. We've broken this wedge formation to the downside. The measure move target here is 95.74. Now, we have seen quite a sustained recovery. We've got some reverse trendline resistance located around about 97.90, and we'd look for that to cap any spikes higher in the dollar index. If we go to this view, still think we've got the possibility of forming a bearish head and shoulders pattern. So left shoulder, head. Are we forming the right shoulder now? We've got a bearish Elliott wave count to the downside, so 5 waves, 1, 2, 3, 4, 5. Okay, then we've seen this recovery higher. Got a 61.8% fib located in 97.64. We're likely to hang around this level or this area until we get the FOMC or the Fed interest rate decision this evening. But all of those different time frames are weekly, and then these two daily views, and plus the monthly time frame that highlights some selling pressure from the top of the cloud, which was at 98.40. So basically all these different time frames are highlighting a bearish bias in the dollar index, but we do need to see a break of some support levels just to confirm that outlook. So if we reflect that back onto euro dollar, and let's just go through some time frames. 61.8% is located at 111.80. You can see that for a prolonged period of time we've been holding around that fib level. If we go to the daily chart, this one first, got a wedge formation breakout, got reverse trendline support, going to be coming in. Let's just have a look. Around about 111.40. So again, we would look for dips to be bought into. This has got a measured move target at 114.48. We've got bespoke resistance at 114.30. If we go to the daily chart, again, different view. Are we forming a bullish reverse head and shoulders pattern? So left head or heads, this is a double bottom. This being the neckline up here, and then potentially let's just get rid of that. Potentially the right shoulder here, close to 111.99, the 61.8% Fibonacci support level. Now, if we go to this time frame, then we can see mixed volatile trading. We've got this ending or bearish corrective channel formation. We've got some bespoke resistance located at 112.20. We've got trendline resistance at 112.20. So what we're looking for today through the FOMC minutes or meeting or interest rate decision, I should say, is a break of that resistance level, and we really do want to see quite an impulsive break. So our call today is we're going to buy a break of 112.20. So that's it'll be a stop order. Okay, so buying a break of 112.20. The target level is 114.30, which is our bespoke resistance just below that wedge formation target at 114.48. And we've got a stop placed today at 111.80. Okay, I hope you've enjoyed that analysis, and we'll speak to you again soon. Many thanks.